Money Show.
Personal Finance with Warren Ingram.
Well, thank you for joining us. Of course, we all have all sorts of experts, whether it's colleagues, friends around the braai, or somebody that's got some advice for you when you meet them at a particular conference or some sort at BRICS, and they tell you, look, I've invested in China and I'm making great returns from this, that, and the other. But you should be really sticking to investment principles for your life. And that's what we have today from Warren Ingram, the co-founder at Galileo Capital, sharing with us tonight some investment principles for life. So do grab your pen and paper, or if you like things electronic, use your phone to take some notes. Warren, this one is quite a tough one, because a lot of people will tell you it's the property that will get you the money. It's this, that, and the other. It's Bitcoin. So at some part during COVID, people were believing in Bitcoin. But what are the key principles of making sure we can create wealth even bit by bit?
But not with Bitcoin, I think. So
No.
I think the first thing is we need to understand investing is really different from trading or from speculating, and maybe it's not semantics. There's kind of like almost a night and day difference. So someone who tries to make money out of speculating or trading, they're looking at any kind of investment, whether it's gold, foreign exchange, cryptocurrency, shares, anything. And they're saying, how can I buy it now, today, and sell it tomorrow or in a week's time and make a quick profit? And an investor looks at something and says, I think this asset that I'm going to buy is very low priced. And if I hold it for a certain amount of time, and it's usually going to be 5, 10, 15 years, I'll be able to sell that asset for a much higher price. And along the way, if it's a property or a share, or a bond, I'm going to get paid some income for holding the investment as well. And I think, the first thing to understand is speculators are few and far between in terms of those that can actually make money over long periods of time. So we'll all know, to use your example, we'll all know about that one friend that will tell you, they bought their crypto or their, Robinhood share or whatever it is, and they made a quick buck. But they don't tell you about the other 99 investments that they tried the same thing and they lost money. We never brag about our losses. We only brag about our gains. And just look at the kind of the world's wealthiest people, and we don't know many speculators. They're not there. They're not at the top of the list. The wealthiest people are investors, and so I think number one, we need to become a lot more obsessed with the long term, and almost kind of try to program ourselves and away from the short term. And maybe just to give an example, when you look at the stock market, if you look at every day when the stock market is open, your chances of the stock market going up are pretty much 50-50. So if you wanted to make money on a daily basis, there is a 1 in 2 chance that you might buy something that will go up today, whereas it equal 1 in 2 chance that it could go down today. And I don't really like those odds. That's like flipping a coin. You might as well just say heads and see what happens and hope you make some money. But as soon as you push that out and you say, well, what are the chances that the stock market makes money when I look at it over a month, and suddenly it goes, 60% chance that you're going to make some money if you invest in the stock market over a month. Over a year, it goes to 72%. Now I'm starting to enjoy those odds, because that's kind of nearly 3 out of 4, every 3 out of 4 times the stock market's going to be up over a year. We get to 5 years and you're at 88%, nearly 9 out of 10 times you're going to make money when you invest for 5 years. That's my first big principle. Let's become obsessed with the long term. And 5 years is, I know it seems like a lifetime when we want to get rich quick, but if you really do want to make money and you really do want to become wealthy, 5 years is not that long. And to give yourself that kind of a chance, 9 out of 10 chance of making money over that kind of time frame, I like those odds. I don't like the 1 in 2 odds. So let's forget the short term and let's focus on the long term.
And Warren, we don't wake up overnight and become long-term investors. What are some of the, nifty things we can do to try and get into the habit of doing things long-term? Specifically speaking to putting money away, learning things like compound interest and things that can get us into the right habits of being a long-term investor.
So when we start out, we've got nothing, right? We earn our first paycheck, however that may be. The first trick is, and it sounds so boring, and so simple, but it's extremely difficult to do. That first paycheck, we've got to take some of the money that we've earned and we've got to put it away, not spend it, not allocate it to some kind of a debt. Yeah, pay ourselves first. Doesn't have to be a lot, but just do a little bit. And it's something that I think in the world, around about 8 out of 10 people all around the world, our country is no difference. We can't get that right. So 8 out of 10 people will spend more than they earn or spend everything they earn if they can't borrow money, every single month of their lives. And that's a really kind of scary, statistic. So number one, you've got to be in the 2 out of 10. You've got to be the person that says, I know it's hard. I know there'll be lots of really, important reasons why I shouldn't be, why I can't save this month or whatever. But you've got to change the mentality to say, I'm going to find a reason. I'm going to find a way to save a little bit of money every single month. And as you save little bits at a time and you start adding those together, you start building that focus on saying, well, hang on, 5 years ago, I had $1,000, but now I've been saving little bits and that $1,000 that I had a while ago has been growing and growing and growing. And that's the power of compounding. And I've been adding to it. And suddenly I don't have $1,000. I've got $10,000. You can't do that if you're spending more than you earn every month. And I know people listening to this are going to go, yes, but, food prices are high. Transport costs are ridiculous. How do we make ends meet? I understand all of that. I hear you. The problem is that those things are not going to be reasons or not going to help you at all when you want to get to financial freedom. You've got to find the way and the reason that you will save. You've got to make a plan, get a side hustle if you need to, but you've got to find a way to kind of put money aside every single month. And I think it sounds so simple, and I know it's not, but that's the absolute golden rule. And then add that to your long-term thinking, and suddenly you're in the 2 out of 10. Suddenly you might be the point of getting to financial freedom early and in control, without having to rely on debt and without having to kind of, work for a boss you hate or in a job you don't like, or paying off debts to the debt providers and just spend your life just, paying paycheck to paycheck to pay off your debts all the time. That's far worse than finding a way to sacrifice a little bit now to kind of take control and be in charge of your life.
And as setting this principle of becoming an investor and, building your wealth, if you will, how do you then set the base of the things you're going to be investing in, firstly, that are going to be long-term and, making sure that you diversify as you invest?
I think you've got two great principles that you're covering in that question. So the one is you have to diversify. So understand that when you're an investor and you're not a speculator, then you need to own a mix of assets. So I think if you're building your wealth over long periods of time, the biggest engine of growth, the most predictable, sustainable way of building long-term capital growth is to invest in the stock market, and not just one stock market. You've got to invest in the JSE, the South African stock market, but you've also got to invest in the global stock markets, because we simply don't know which markets are going to deliver great returns over the next 10, 20, 30 years. There'll be really clever people now saying it looks like India's on its way. And I believe that, but I can't tell you that with conviction. I can't say I'm going to bet my entire future that India is the place to go and allocate all my money. So what I'm going to do is I'm going to allocate some money to the old world, to Europe, to the US, to Japan. I'm going to allocate some money to emerging markets in South America and Africa. And including then India. So it's spreading your money across the world, and definitely with a strong focus on the stock market as a big engine of of growth. But that doesn't mean you don't have some money in cash. We all need cash, for an emergency fund, for example. We need cash for kind of, building up savings for replacing cars from time to time and whatever else we need to kind of spend in time. We should do that with savings from cash, not with shares. And then maybe, owning some property companies along the way. Property companies have been a really lousy investment over the last few years as interest rates have shot up. But when interest rates start to fall down again, that will be favorable for property companies. And once again, I'm not saying only in SA. I'm saying all around the world.
Yeah.
So I think having a good blend of assets makes a lot of sense to me. And you can do it really simply. I'm not saying you need to become a stock market expert on your own. You can buy an exchange traded fund that owns all of these things. You can buy a kind of a balanced unit trust that does all of that for you. What you have to do is start and get going, and don't kind of keep thinking about it. You can't think yourself rich. You've got to act rich. You've got to get it going now.
And Warren, let's think about it like a flip file. Let's say I'm starting out to invest and I've got my flip file. It's still empty. What are some of those, documents in terms of investments I should be having in there? The basics that when you open it as an advisor, you want to see in that particular flip file.
I'm really hoping that when we open that flip file, and gee, Mateo, you're sounding as old as me now. Flip files nowadays, it's someone's app that they just send you. But what I want to see, in an ideal world is no major short-term debt. In other words, no credit card debt, no personal loans, no overdrafts. Maybe a home loan, that's acceptable. Maybe an affordable car loan, not the one that's financed over 6 or 7 years at, 13% and consuming your entire salary. That's not affordable. And then I want to see, either a kind of a combination of, tax-free savings account where you're putting away as much money as you can, into your tax-free savings. And I always think, it's the first, no-brainer investment that we should be making. And no-brainer means that's a good thing. I mean, we don't get a lot of free rides from our friends at SARS, and this is one. If you invest in the tax-free savings, over your lifetime, it'll take you probably 16 or so years to get to the 500,000 Rand maximum that we're allowed to put in. But if you do that and you're investing in tax-free savings that has a huge exposure to shares and not to cash, over your lifetime, that could end up being, a few million Rand that you can start to draw on completely tax-free. That for me is one thing we need to have, all of us, when we start saving, our first long-term thing that we do is tax-free savings. I like the idea of a retirement annuity because it's the other tax break that SARS gives us is contributions to retirement annuities give us a deduction against the taxes that we have to pay. And again, you don't have to buy an expensive one and you don't have to kind of get stuck in a big contract. There are retirement annuities that are pay as you go. So if you're in the gig economy where you don't get a predictable salary, then when you do get an income and you are paying tax, then take some of that money and put it into an RA when you can afford to do it. Don't lock yourself into kind of a mindless contract when your income is variable. That's another thing, to just be careful of signing long-term contracts. I think those are two kind of big ones for me. And then, if you've got some extra money, then look at an exchange traded fund, in SA and another one, on global markets. That would be a great starting point.
If you could just hold it there, Warren. Of course, we're in conversation with Warren Ingram, the co-founder of Galileo Capital, speaking to us about some investment principles for your life. So the essentials that you should have as a long-term investor. Of course, we'll pick up on this conversation after this.
The Money Show.
Personal Finance with Warren Ingram.
We pick up the conversation now with Warren Ingram, giving us the personal finance principles as an investor. Warren, if we look at drawdowns, if you can just explain what drawdowns are and how they affect investors in the market.
So, drawdowns is unfortunately a bit of jargon, but it is a nice term for explaining that when you invest in the stock market, there are going to be days or weeks or months during the year when the stock market goes down. So let's just say the stock market starts at a level of 1,000 on the 1st of January. and it ends the year on the 31st of December at 2,000. So over the year, it's gone up. But what will happen during the year is it will get, let's just, choose an example. 31st of March, it'll go from 1,200 and it will drop to 900. And then through April and May, it will start rising again and it will get to, 2,500 and then it will fall again down to 1,900 and so on and so on. So those drops from one level down, is called a drawdown. And drawdowns are absolutely part and parcel of investing. And they will happen every single year. There isn't a year when the stock market doesn't have a drawdown. Unfortunately, what happens is when that drawdown actually does take place, investors freak out. They kind of lose their rag because they think this is it. Yeah, we don't want to lose money. It's the end of the world. It's going to go down more tomorrow and it's going to go down more the next week. And I'm never going to make my money back. And so they move to cash. And that's the other point. If we're obsessed with the long term, understand that over long periods of time, there are going to be days, weeks, months, maybe even a year or two where you do lose money. That's okay. That's normal. Understanding that, over long periods of time, the stock market goes up way more than it goes down. If we look at the American market, they do great research on the American market. Over 94 years, the American market has been up 68 times over those 94 years and only down 26 times. So your odds of making money if you stay invested are really, really good. Kind of 72% of the time you're going to make money. And that's, that's kind of easy to do if you stop looking at things every day and you make peace with the fact that somewhere along the line you're going to lose some money and that's okay. It'll recover.
So burning your fingers is not all that bad then.
No, because it's not permanent. Things do bounce. As long as you haven't put all of your money, we spoke about diversification. You can't go put all of your money on one share. Think of Steinhoff. It's not a good thing to do. Got to buy lots of shares.
We have a listener question now, just for you to answer. One that's quite simple and I'm sure a lot of people can relate to. The listener says, I'm a 28-year-old single guy with no kids. My mother recently advised me to get a funeral cover. I'd like to leave something behind for my family, that being my mom and 2 siblings, should I pass away. Now, I'm considering getting a life cover instead of a funeral cover. The reason for this is that my family can use the life cover funds for my funeral proceedings and the rest of the money to take care of their needs as well after my funeral. Is this the best strategy?
I love that. I love this idea. I think we must understand funeral policies are vital in South Africa. There are a lot of people, who can't afford, to pay a life assurance premium, on large amounts, and they can afford to pay a much smaller amount on a monthly basis to cover a simple cost of a funeral. And what I mean by simple cost is there's no underwriting. There's no insurance company that says, look, we need to send you for medicals, you need to go to a nurse and have blood tests and all that stuff. You simply say, I'm going to get, I want to buy 50,000 rands worth of cover or 500,000 or, whatever the number is of cover in the event that I die for funeral expenses. So it's a fixed amount on your death. And so that's valuable when you can't afford a bigger premium to buy proper life cover. But what we need to understand is, although it's a small monthly payment, funeral cover is actually really expensive. For the amount of cover that you're actually getting. So let's say, for every rand that you spend on a premium, the amount of insurance that you're actually getting back is quite small. But because we're dealing in small numbers, it seems affordable and it seems cheap. The answer is it is affordable, but it's not cheap. And that's the tragedy of families where they end up with 5 or 10 or 15 funeral policies per person, which is the case in our country. There are lots of salary earners who've got lots and lots of funeral policies. And people who are spending that much money on funeral policies would do way better just to get a single life policy, worth a lot more. And then they can provision for everybody. And so, yes, please get the life policy and not the funeral policy if you can afford it.
All right, that's sound advice coming from Warren Ingram, the co-founder of Galileo Capital. Today, speaking in our personal finance feature for some investment principles for your life.